All right, welcome to our course on CFA Level 1 2025 Financial Statement Analysis. We're kicking things off with Module 1, which is all about building that solid foundation. Look, by the time we're done here, you're not just going to know some definitions. You'll actually get the purpose, the process, and the core tools that every top analyst uses to turn a pile of numbers into a smart decision. So, here's the game plan for today. We're going to start with the big why. What financial analysis really is. Then we'll get into the how with a super important 6-step framework. After that, we'll cover the what, the key documents you'll be digging through. And finally, we'll talk about the rules of the game that you absolutely have to know for the exam. Right. First things first. What are we really trying to do as analysts? Let's be clear. It is not about being a human calculator. The real skill is taking all that raw data and turning it into an insight, a story, something that actually helps someone make a decision. I want you to picture this. Someone drops the annual reports for Reliance Industries from India and Apple from the US right on your desk. We're talking about a mountain of paper, hundreds of pages each. It's a fire hose of information. So the question is, where in the world do you even begin? This is the fundamental challenge we're here to solve. And here's what it all boils down to. Financial statement analysis is basically a system, a structured way to answer really important real-world questions. Questions like, should I buy stock in Apple? Or should my bank give a loan to Reliance? It's all about using the financial data we have to make intelligent decisions that have real economic consequences. So, to tackle that mountain of data, you can't just wing it. You'd get lost in about 5 minutes. You need a map, a reliable process you can follow every single time. And that is exactly what this 6-step framework is. It's your guide. And here it is. These are the 6 phases of your journey. It takes you logically from a very broad question all the way to a specific, well-supported recommendation. And it doesn't stop there. This framework keeps you on track. Think about these first 3 steps like you're preparing for a major expedition. First, you have to know your destination, right? That's articulating your purpose. Are you a stock picker or a lender? That changes everything. Then you gather all your supplies, financial statements, industry reports, economic forecasts, and finally, you organize your backpack. That's processing the data, calculating key ratios, and getting everything ready to go. Now here's where it gets really interesting, especially that last step, follow-up. After you do all the hard work, analyze the data, and write up your brilliant buy, sell, or hold report, you're not done. The best analysts know that the world keeps changing. A company reports new earnings, a competitor makes a big move. You have to constantly check back in and see if your original conclusions still make sense. It's a living process. Okay, so we have our map. Now, what about our tools? Where does all this information actually come from? Let's look at the essential sources you'll be using. I want you to start thinking of yourself as a financial detective. You're trying to piece together the real story of a company's health. And these documents, they're not just boring homework. They are your primary sources of evidence. This is where you find the clues. And this table shows a crucial difference you have to understand. The glossy annual report, that's the company's marketing brochure. It's what they want to tell you. But the Form 10-K, that's the legal filing they have to submit to regulators. It's what they must tell you. Guess where you're going to find the really important, nitty-gritty details? Yep, in the 10-K. And buried inside that 10-K is a section that is absolute gold. It's called the Management Discussion and Analysis, or MD&A. You need to read this carefully. It's where the top executives explain their results, talk about the business, and give you their outlook. It's like getting a direct briefing from the people in charge. Here's a pro tip. Before you dive into any of the numbers, find the auditor's report. Think of it as the health certificate for the financial statements. You're looking for one phrase, an unqualified or clean opinion. That's the green light. If you see anything else, like a qualified or adverse opinion, that is a huge red flag. Stop what you're doing and figure out why. Now, as an analyst today, you're working in a global market, so that means you've got to be bilingual. In accounting, that is. You need to understand the two main languages that companies use to report their financials around the world. Those two languages are US GAAP, which is what US companies use, and IFRS, which is used by most of the rest of the world, including companies in India and Europe. The simplest way to think about the difference is that US GAAP is like a very detailed rulebook, while IFRS is more like a set of guiding principles that requires more professional judgment. And believe me, these differences matter a lot. Take inventory, for example. Under US GAAP, a company like Tesla can use the LIFO inventory method. But under IFRS, which an Indian company like Infosys uses, LIFO is completely forbidden. So if you just compare their profit margins without adjusting for that, especially when prices are rising, you're going to get a totally misleading result. It's a classic apples to oranges mistake. Okay, we've covered a ton of ground here, so let's boil it all down. What are the absolute must-know concepts from this module that you need to have locked down for the CFA exam? Here's your checklist. First, always remember the ultimate goal is to make economic decisions. Second, memorize those 6 steps of the framework. That's a favorite exam topic. Third, know your key documents, the 10K, MD&A, and the proxy statement. Fourth, an unqualified audit opinion is the gold standard. And finally, be an expert on those key differences between IFRS and GAAP, especially LIFO inventory. All right, let's do a quick knowledge check with a CFA-style question. Take a look. Which of these options best describes the role of financial statement analysis? Go ahead and pause here for a second, read the choices carefully, and pick the best answer. If you chose C, you nailed it. And here's why it's the best answer. Options A and B are certainly things we look at. They're the inputs. But the ultimate purpose, the role of the analyst, is to use all that past and current information to form an opinion about the future. Investing is all about the future, so our analysis has to be forward-looking. And that brings us to the end of Module 1. We've built the foundation. You now have the map, that 6-step framework, and you know what tools you need from your toolkit. Now that we've got the why and the how down, we're ready to get to work. Next up, in Module 2, we're going to dive deep into the income statement. See you there.
Welcome back to our course on CFA Level 1 2025 Financial Statement Analysis. Today, we're jumping into Module 2, Analyzing Income Statements. And we're going to focus on the absolute bedrock principles of it all, revenue and expense recognition.
Okay, so let's just dive right in with a big question that really gets to the heart of the income statement. It seems so simple, right? When a company makes a sale, when does it actually earn the money? Is it when the cash hits their bank account, or is it something else entirely? The answer to this changes everything.
So here's our game plan for today. First, we're going to walk through the official rule book for revenue. Then, we'll see how those rules play out in the real world. After that, we'll flip the coin and talk about expenses, zeroing in on a really critical accounting decision. And finally, we'll tie it all together and talk about why this is so important for you as an analyst.
All right, first up, the answer to that question we just asked, it all lies in something called accrual accounting. See, it's not about when the cash changes hands. It's about when the revenue is actually earned. And for that, both IFRS and US GAAP have given us a very specific 5-step rulebook to follow.
Okay, I know, that sounds like a bit of a mouthful, right? So let's just break it down into plain English. The core idea is this. You recognize revenue when your company actually fulfills its promise to the customer. You know, when you hand over control of the good or service. And the amount you record is what you genuinely expect to get paid. So, to make that principle happen, accountants follow this awesome 5-step model. Think of it as a logical path. First,
You make sure you have a real contract. Then, you figure out exactly what you promised to do. We call those performance obligations. Next, you figure out the price. Then, you split that price up among all your different promises. And finally, this is the magic moment. You recognize the revenue as you actually do the work or deliver the goods.
Okay, now lean in for this one because this is a classic exam tip. It's a subtle but super important difference in step 1. Both IFRS and US GAAP say that for a contract to be valid, collection has to be probable, but they don't define probable the same way. Under IFRS, it just means more likely than not, so a 51% chance. But under US GAAP, it's likely to occur, which is a much higher bar. You gotta know that difference.
All right, theory is great, but let's see how this 5-step model actually applies to the kinds of complex, real-world businesses you'll be analyzing every single day.
This distinction is huge. You have to know if a company is a principal or an agent. So for example, when Amazon over in the US sells its own Kindle, it controls the product. It's the principal. So it books the full $100 as revenue. But think about a seller on Flipkart in India. Flipkart is just the platform, the middleman. They're the agent. They don't report the whole sale, just their commission, maybe $30. You can see how this massively changes the top-line revenue and the gross margins you're looking at.
And this same logic has a huge impact in the tech world. You take a company like Microsoft in the US selling a perpetual software license. Oftentimes, that's a one-and-done deal, so the revenue gets recognized right up front. But then you look at a company like India's Tata Consultancy Services, providing a cloud subscription. That's a service delivered over time, so the revenue gets spread out or recognized ratably, month after month over the whole contract. Big difference.
Recognizing revenue is only half the story, right? To get to the bottom line, to get to profit, we have to account for all the costs we spent to make that revenue happen. And that brings us to a really foundational idea, the matching principle.
The principle itself is beautiful in its simplicity, but it's so powerful. You match your expenses directly to the revenues they helped create. The classic example here is cost of goods sold. You don't record the cost of your inventory as an expense when you buy it. No, that would be wrong. You wait, and you expense it in the exact same period that you sell that inventory and recognize the revenue. They have to match.
Okay, now we're getting to one of the most important judgment calls in all of accounting. This is an area where management gets to make a choice that can totally change the look of the financial statements. The question is, should we expense a cost right away, or should we capitalize it as an asset?
So what's the difference? Well, if you capitalize a cost, you stick it on the balance sheet as an asset. Then you slowly expense that cost over its useful life. We call that depreciation. But if you expense it, bam, the entire cost hits your income statement right now, in this period.
And what's really wild is just how massive the impact of this one decision can be. Check this out. We have two identical companies. They both buy 900 euros of equipment. Cap Inc. decides to capitalize it, and look, they report 490 euros in net income. But Now Inc. expenses it all at once, and their net income is only 70 euros. That is a 7 times difference, all from one single accounting choice.
And the ripple effect on key ratios is just wow. Because Cap Inc. has higher reported income and higher equity, its return on equity looks amazing, 39%. Meanwhile, Now Inc., which is doing the exact same thing in the real world, reports a measly 7% ROE. If you didn't know better, you'd think Cap Inc. was a way better company.
So let's just nail this down. Capitalizing makes the present look fantastic. It boosts your net income, your assets, your equity, and this is a key one, it even boosts your cash flow from operations, because that purchase gets filed under investing cash flow, not operating. On the flip side, expensing hurts your results now, but it can actually set you up for what looks like better profit growth in the future. It's a trade-off.
Okay, so let's bring this all home. Let's put on our analyst hats. Why do we, as financial analysts, need to be so completely obsessed with these little accounting details? Because your job is to be a detective. You have to look past the numbers on the page. You need to dig into these policies. Is this company being too aggressive with how it recognizes revenue? How does their capitalization policy stack up against their competitors? Your whole goal is to make adjustments so you can compare apples to apples and make forecasts based on economic reality, not just accounting tricks.
And that brings us to the final thought you should always have in the back of your mind. Question everything. Always ask why a company is making the accounting choices it's making. That officially wraps up our deep dive into Module 2. We've hit the 5-step model for revenue and the huge decision to capitalize or expense costs. Next up, we're going to dive into Module 3, where we'll explore non-recurring items and what happens when companies change their accounting policies. I'll see you there.
Welcome to Module 6 of our CFA Level 1 2025 course on financial statement analysis. Today, we're going beyond the assets you can physically see and touch. We're going to dig into some of the most complex and, frankly, most valuable items you'll find on a balance sheet.
But first, let's start with a little thought experiment. For a company like Coca-Cola or Apple, what's truly worth more? Is it a physical factory they own, or is it that globally recognized brand name? You know, the answer isn't always so clear-cut, and that's exactly what we're going to explore today. So, we're talking about these invisible assets. As an analyst, you absolutely have to know how to value them, how they're accounted for, and how to spot those critical differences in reporting around the world. So let's get right into it with our first category. First up, intangible assets. We're talking patents, licenses, trademarks, all that stuff you can't see, but for many modern companies, this is the real backbone of their business. So what is an intangible asset really? Well, the official definition is an identifiable, non-monetary asset that has no physical substance. Think about a patent that protects an incredible invention, or a trademark that protects a brand, or even a valuable list of customers you get when you buy another company. The key word here is identifiable. It means you could, in theory, separate it from the company and sell it on its own.
Now, how we account for these things really depends on how long they're expected to last. If an intangible has a finite life, like a patent that expires in 20 years, we amortize it. We basically just spread its cost over that useful life. But if it has an indefinite life, like a super powerful trademark that could last forever, we don't amortize it. Instead, companies have to test it for impairment every single year to see if it's lost value.
Okay, for the exam, you need to tattoo this on your brain. The huge difference between IFRS and US GAAP for R&D. Under IFRS, it's a two-stage process. The research phase costs, those get expensed. But once you hit the development phase and things get serious, you can actually capitalize those costs as an asset. Now, under US GAAP, it's way simpler. Almost all R&D is expensed as it happens. So what's the takeaway for an analyst? It means a US tech company can look less asset-rich and have lower profits than an identical IFRS company during a big development push. That's a huge distortion you need to be able to spot.
Let's look at a U.S. example, Apple. Even though they expense all their internal R&D because of U.S. GAAP, their balance sheet still shows billions in acquired intangibles. These are things like patents and licenses they bought from other companies, and because those have finite lives, they get amortized, just like we talked about.
Now, for an Indian example, think about a tech giant like Infosys, which reports under IFRS. They pour enormous amounts of money into creating their own software. Because they follow IFRS, as soon as a project becomes technologically feasible, moving from just research into actual development, they can start capitalizing those costs. This creates a really significant intangible asset on their balance sheet, and it really reflects the future value of all that innovation.
All right. Next up is a really special kind of intangible that you can't just go out and buy on its own: Goodwill. It only ever shows up on a balance sheet when one company buys another, and it basically represents the premium paid for the target's secret sauce.
So what is this secret sauce? Well, Goodwill captures all the valuable stuff that isn't listed as a separate asset. We're talking about a fantastic reputation, a super loyal customer base, a brilliant management team, or just the synergies you expect to get from the deal. It's the extra cash an acquirer pays over and above the fair market value of the company's identifiable net assets.
And calculating it is actually pretty straightforward. It's a three-step process. You take the total purchase price, you subtract the fair value of the net assets you actually got in the deal, and whatever is left over, that premium you paid, that's your goodwill. Simple as that. Now here's the golden rule for goodwill, and it's a lot like those indefinite life intangibles we saw. Goodwill is never amortized. You don't just write it down bit by bit. Instead, management has to do an impairment test at least once a year to check if the value of that company they bought has gone down. If it has, they've got to write down the goodwill.
And believe me, these impairment charges can be absolutely massive. A classic U.S. case was back in 2009, when the retailer Safeway took a goodwill impairment charge of nearly $2 billion. That single charge wiped out over 80% of their goodwill. It was a massive signal to investors that the acquisitions they'd made in the past just weren't paying off.
For our Indian example, let's look at that historic acquisition of Chorus by Tata Steel. Tata paid a huge premium over Chorus's net asset value. And that massive premium? It was recorded on Tata's balance sheet as goodwill, representing the incredible strategic value, the market entry, and all the synergies that Tata was banking on.
Okay, let's switch gears and hit our final topic, financial instruments. This category covers a company's investments in things like stocks and bonds. Now, the accounting here can feel a little tricky, but it really all just comes down to one thing: management's intent.
To figure out how to account for any financial asset, you really only need to ask two simple questions. First, how is it measured on the balance sheet? Is it at its original cost or at its current market value? And second, where do the changes in its value actually get reported? Do they hit the income statement and affect profits, or do they bypass it and go somewhere else?
This table is your cheat sheet. It pretty much summarizes everything you need to know. See the three main categories? First, you've got amortized cost. With these, you just ignore the day-to-day market buzz. Second is fair value through OCI. Here, value changes are tracked, but they go into equity, not the income statement, which keeps earnings stable. And third, you have trading securities, where every little wiggle in price goes straight to the bottom line, affecting profit in real time. It all comes down to what the company plans to do with that investment.
A perfect U.S. example here is Apple's giant investment portfolio. I mean, they hold hundreds of billions in bonds. By classifying most of them as available for sale, they report them at fair value, which is great, but the daily unrealized gains and losses completely bypass their income statement. This prevents these wild swings in their reported earnings every quarter. And just look at this chart from a few years back, it really drives the point home. For a company like Apple, financial instruments aren't just some small thing on the side. They're a massive piece of the puzzle. At this point, marketable securities made up a staggering 2/3 of their entire asset base. So yeah, understanding this accounting is pretty critical to understanding Apple. And in the Indian context, think of a massive bank like the State Bank of India, or SBI. SBI manages this huge portfolio of Indian government securities, or GSECs. How they choose to classify those bonds may be held to maturity for liquidity, available for sale for flexibility, or held for trading to make a profit. That decision has a direct and pretty significant impact on their reported income, their capital ratios, and their overall financial health. All right, that was a pretty deep dive into some complicated assets. So let's just take a breath and quickly recap the absolute must-know points from this module. So remember these three big ideas. 1. For intangibles, their useful life tells you the accounting. And that IFRS versus GAAP rule on R&D can seriously warp comparisons between companies. 2. For goodwill, it's not amortized, but an impairment charge is a giant red flag that a company's past acquisitions might have been a mistake. And finally, 3. For financial instruments, classification is everything. It tells you exactly how much earnings volatility a company is willing to live with.
Fantastic work getting through these key non-current assets. That officially wraps up Module 6. So, in Module 7, we're going to flip over to the other side of the balance sheet and start analyzing non-current liabilities and some key ratios. I'll see you there.
All right, welcome to our CFA Level I 2025 course on financial statement analysis. We're diving right into Module 8 today, and we're tackling one of the most powerful tools in your toolkit, the statement of cash flows. So let's kick things off with a real head scratcher. I mean, how is it possible that you see a company in the news reporting record profits, everyone's celebrating, and then, seemingly out of nowhere, they file for bankruptcy? It doesn't seem to make sense, right? Well, the answer is right here. It's the critical difference between profit and actual cold, hard cash. See, the income statement, that runs on what's called an accrual basis. It books a sale the second the deal is done, even if the cash won't show up for months. But the cash flow statement, it's brutally honest. It doesn't care about promises. It only tracks the dollars that physically come into and go out of the bank account. You've probably heard the saying, profit is an opinion, but cash is a fact. And that's exactly what we're talking about. So, to make sense of all this cash flying around, the statement neatly organizes everything into 3 main activities. I like to think of them as 3 big buckets that every cash transaction gets sorted into. First up, you've got operating activities. This is the lifeblood of the company, the cash generated from its main business. This bucket tells you if the company's core model is actually sustainable. Then you have investing activities. This shows where management is putting its money to grow for the future, buying new factories, equipment, or even other companies. And finally, financing activities. This tells the story of how the company is raising money, think issuing stock or taking out loans, and how it's paying back its investors, like buying back shares or paying dividends. Now, we're going to zero in on the one section that analysts and investors obsess over the most, cash flow from operations, or CFO. And here's where it gets kind of interesting. Companies actually have 2 different ways to get to this number. On one side, we have the indirect method. The vast majority of companies, we're talking over 98%, use this one. It cleverly starts with net income from the income statement and then makes a series of adjustments to work its way back to cash. On the other side is the direct method. It's way more straightforward. It literally just shows you cash we got from customers and cash we paid to suppliers. It's easier to understand for sure, but you almost never see it. So for our purposes, we're going to focus on mastering the indirect method. Think of the indirect method as building a bridge from the opinion of net income to the fact of cash flow. It's a really logical 3-step process. You start with net income, your bottom line from the income statement. Then you add back any expenses that were on the income statement but didn't actually involve cash leaving the building, like depreciation. And the final step is to adjust for the changes in your day-to-day operational accounts, your working capital. Now, that last step can trip people up, but here is the golden rule you need to burn into your memory. An increase in an asset is a use of cash. An increase in a liability is a source of cash. Just think about it for a second. If your inventory, an asset, goes up, it's because you spent cash to buy it, right? That's a use of cash. If your accounts payable, a liability, goes up, it means you're holding on to your cash longer instead of paying your suppliers. That's a source of cash. Let's make this real. Picture a US company like Tesla. They build a ton of new cars, and those cars are now sitting on their lots. Their inventory, an asset, has just shot up. Well, they had to spend a whole lot of cash on steel, batteries, and labor to build those cars. That's cash that went out the door. So to get from net income to true operating cash flow, we have to subtract that big increase in inventory. Now, let's switch gears and head to India. Think of a service giant like Infosys. They finish a huge consulting project, and they can book all that revenue, which makes their net income look great. But what if the client hasn't paid them yet? Their accounts receivable, basically an IOU from the client and another asset, goes up. They've earned the money, but they haven't received the cash. So again, that increase in an asset is a use of cash, and it has to be subtracted. And just to round this out, remember that direct method we mentioned? It skips this whole reconciliation process. It just gives you the totals. It would literally say, cash received from customers was X, and cash paid to suppliers was Y. It's clean, simple, kind of like reading the company's bank statement for the year. Okay, here's a topic the CFA Institute absolutely loves to test. As an analyst, you can't just know your local rules, you have to be global. That means understanding the key differences between IFRS, which is used pretty much everywhere else in the world, and US GAAP. And this table lays out the main battleground. Look at all those ORs under the IFRS column. The key word here is flexibility. Under the strict rules of US GAAP, for instance, any interest a company pays must be classified as an operating cash flow. No exceptions. But under IFRS, a company gets a choice. They can call it an operating flow, or they can argue it's part of their financing strategy and put it in the financing section. So here is your big exam tip. When you're analyzing a US company like Apple, you know without a doubt that interest paid is in the operating section. But if you're looking at an IFRS company, say in India or Europe, you have to actually check the footnotes to see where they decided to put it. This is a huge deal because it can make it really tricky to compare the operating cash flow of a GAAP company and an IFRS company. All right, theory is great, but let's see how this plays out in an actual exam-style question. Take a second and read this carefully. The key phrases are indirect method and addition to net income. So we're starting with net income, and we're looking for something we need to add back. Go ahead and think it through. So did you get it? The correct answer is B, a loss on the retirement of debt. Here's why. That loss reduced your net income, but it's not an operating activity. It's a financing one. So we have to add it back to reverse its effect. A gain, like in option A, would be the opposite. We'd subtract it. And an increase in accounts receivable, as we just discussed, is a use of cash, so that gets subtracted too. So after all these rules and reconciliations, let's get to the big picture. Why do analysts put so much weight on this statement? What's the so what? It's because this statement is the moment of truth. It cuts through all the accounting jargon and estimates. It tells you if the company has the actual real money to pay its bills, to fund new growth projects, to pay down its debt, and to reward its shareholders with dividends. It is the ultimate report card on a company's financial health. Okay, before we wrap up, let's boil this all down to the 3 things you absolutely have to walk away with from this module. Number 1, profit is not cash. Never, ever forget that. Number 2, know the indirect method cold. Start with net income, add back non-cash charges, and adjust for working capital changes. And number 3, know those IFRS versus GAAP differences, especially around interest and dividends. I can almost guarantee you'll see a question on that. So I'll leave you with a question to think about. If you could only look at one number to judge a company's health for a year, would you pick its profit or its cash flow? That wraps up Module 8. Awesome job today. Next, we're going to build on this in Module 9, where we'll dive into analyzing free cash flow and some really important cash flow ratios. I'll see you there.
Welcome back to our course on CFA Level 1 2025 Financial Statement Analysis. Today, in Module 9, we're really leveling up. We're moving beyond just understanding the cash flow statement and into mastering two of the most powerful tools an analyst has: free cash flow and cash flow ratios. Let's get right into it.
You've probably heard this one, right? Profit is an opinion, cash is a fact. It's a classic for a reason. But a list of numbers, facts, isn't enough. Our job as analysts is to find the story behind those facts. What is the cash telling us about the company's strategy, its health, and where it's headed? So how do we start unraveling that story? Well, it all begins with a solid framework.
Look, before you even think about calculating a single ratio, you need a plan. A systematic approach is absolutely crucial. It stops you from getting lost in the weeds and helps you see the big picture, how all the pieces of the cash flow puzzle fit together.
And here is that plan. It's a really straightforward 4-step process. First, we start with a bird's eye view. Where's the cash coming from? And where's it going? Simple as that. Then, we zoom in on each section: operations, investing, and financing, to figure out what's really driving the numbers. Think of this as your roadmap for any cash flow statement you ever look at.
This brings us to our first major checkpoint. For any healthy, established company, the cash it generates from its main business, its operating cash flow, should be positive. And not just positive, it needs to be strong enough to pay for all its capital expenditures. The investments it needs to maintain and grow. If a company's core operations can't find its own upkeep, that's a serious red flag.
So once we have that big picture, it's time to put the numbers into perspective. Because looking at raw dollar or rupee amounts can be super misleading, right? Comparing a huge company to a small one, or even the same company from 5 years ago, it's like comparing apples and oranges. To make real meaningful comparisons, we use a fantastic tool called common size analysis.
And there are two main ways we can do this. First, we can look at each cash item as a percentage of total inflows or outflows. This is great for seeing, what slice of the pie each activity represents. But the second method is often where the real magic happens, expressing everything as a percentage of net revenue. This directly links how well the company is selling its products to how much cash it's actually generating. It's an incredible tool for forecasting.
Okay, this brings us to the star of the show: free cash flow. While net income is influenced by all sorts of accounting rules and choices, free cash flow is the real deal. It's the actual, tangible cash a company has left over after paying all its bills and making the necessary investments to stay competitive. This is the cash that's truly free to pay down debt or reward shareholders.
We'll start with free cash flow to the firm, or FCFF. The easiest way to think about this is as the total cash pie that the business generates. It's the amount of cash available to everybody who has a claim on the company. That means both the lenders, the debt holders, and the owners, the equity holders. So how do we calculate it? Well, the most direct way starts with a number we already know: cash flow from operations, or CFO. From there, we just need to make two key adjustments. First, we add back the after-tax interest expense. And second, we subtract the money the company spent on capital expenditures, which we call FC&V, for fixed capital investment.
Now, you might be asking, wait a minute, why are we adding back interest? It's a great question. Remember, the CFO number is calculated after the company has already paid interest to its lenders. But since FCFF is the cash available to all capital providers, we have to add that interest payment back into the pie. We use the after-tax amount because paying interest actually saves the company a bit on taxes.
Okay, so if FCFF is the whole pie for everyone, what about free cash flow to equity, or FCFE? Well, this is the slice of the pie that's left over just for the common shareholders. This is the cash that's available after everyone else, especially the debt holders, has been taken care of.
The calculation here follows a really clear logic. We start again with our good friend CFO and subtract those capital investments. But this time, instead of adding back interest, we have to account for all the cash flow related to debt.
We add any new money the company borrowed and subtract any debt it paid back. That difference is what we call net borrowing.
Beyond just calculating free cash flow, we can use the cash flow statement to build out a powerful diagnostic toolkit of ratios. Think of these like a doctor's quick tests. They give us a standardized way to check the vital signs of a company's financial health and performance.
This table shows 4 absolutely essential ones. And you'll notice they all use cash flow from operations as their starting point. They measure everything from performance, like cash return on assets, to solvency, like the debt coverage ratio. The one I really want you to watch is the reinvestment ratio. If that's over 1, it means the company can fund its own growth with the cash from its operations, which is a fantastic sign of strength.
All right, theory's great, but let's make this real. A company's cash flow statement tells a story about its strategy. So let's compare 2 famous companies that are telling very different stories with their cash.
Let's start in India with a powerhouse like Reliance Industries. For them, the story is all about growth. Their cash flow statements are often dominated by massive outflows in the investing section for capital expenditures. They are plowing cash back into the business to build out their telecom and retail empires. Now contrast that with a mature tech titan in the US like Apple. Apple generates unbelievable amounts of operating cash, way more than it needs to reinvest. So its story is told in the financing section, with huge cash outflows for stock buybacks and dividends, basically showering its shareholders with that excess cash.
Okay, let's switch gears and put on our exam hats. You've seen the concepts, you've seen the real-world examples. Now, let's tackle a CFA-style question.
Take a good look at the question. Which of these is the right way to compute FCFF? Think back to that formula, and more importantly, the logic behind each piece. Feel free to pause and think it through.
And the correct answer is B. Let's do a quick walkthrough of why. We always start with CFO. Then we add back the after-tax interest because that cash really belongs to the debt holders. It's part of the total pie. And finally, we subtract the capital expenditures because that's the cash needed to keep the business running and growing. What's left is the cash available to all capital providers.
So, let's wrap this up with the key things you need to walk away with. First, always start with the 4-step framework to see the big picture. Second, use common size statements to standardize the numbers and make smart comparisons. And third, master how to calculate what's truly free, both free cash flow to the firm and to equity. That wraps up Module 9 on Advanced Cash Flow Analysis. You did great. Next up, we're going to dive into Module 10 and completely demystify the analysis of inventories. See you there.
Welcome back to our CFA Level 1 2025 Financial Statement Analysis course. We are working our way through Volume 4, and today we're jumping right into Module 10, Analysis of Inventories.
So, let me ask you a question that might sound a little strange. What can a company's warehouse tell you about its stock price? Well, it turns out, a whole lot. The stuff a company has sitting on its shelves holds critical clues about its financial health. In this explainer, we're going to see how this physical asset, inventory, tells a crucial story about a company's profitability and its future.
We're going to build your analyst toolkit piece by piece. We'll kick things off with why inventory is so important in the first place. Then we'll get into how it's valued, the huge impact of different costing methods, the key ratios you'll be using to check performance, and finally, where to dig to find the real story in the financial disclosures. For any company that makes or sells physical goods, inventory is a, if not the, primary driver of profit. But what's really critical for us as analysts is that the accounting choices a company makes here can dramatically change its reported earnings and the value of assets on its balance sheet.
And this is exactly why, as an analyst, you simply cannot make an accurate apples-to-apples comparison between two companies, or even track one company's performance over time without first understanding which inventory methods they're using and knowing how to adjust for them. It is absolutely fundamental.
All right, let's grab our first tool. This is the bedrock principle of inventory valuation. Its whole purpose is to stop companies from overstating the value of their assets and, looking healthier than they actually are.
In plain English, the rule is pretty simple. A company can't carry inventory on its books for more than it realistically expects to get from selling it. So if the value drops, maybe because the product is obsolete or damaged, the company has to recognize that loss right away by writing the inventory's value down.
Now here's where we see a subtle but really important difference between IFRS and US GAAP. At first glance, lower of cost or NRV and lower of cost or market sound pretty similar, right? But the real divergence, and the one you have to watch out for, is what happens with write-downs.
And this slide right here is probably the most important distinction for the exam. Under IFRS, if inventory that was written down suddenly recovers its value, the company can actually reverse that write-down. But under US GAAP, no way. Once it's written down, it stays down. That loss is permanent.
Okay, next up is our second tool, and trust me, it's a big one. We're not talking about the physical flow of goods here, but the assumed flow of costs. And the choice between methods like FIFO and LIFO can have a massive impact on a company's reported profit and its tax bill, especially when prices are on the move.
You can think of this slide as your cheat sheet for a rising price environment. With FIFO, or first in, first out, we assume the oldest, cheapest goods are sold first. That leads to a lower cost of goods sold, or COGS, which means higher reported profits. LIFO, last in, first out, does the exact opposite, giving you a higher cost of goods sold and lower profits.
So, let's take a U.S. example. Imagine a big retailer like the Kroger Co. operating under U.S. GAAP. During a period of inflation, they can use LIFO. This matches their newest, most expensive inventory costs against their current sales, which results in lower taxable income. It's a huge tax advantage. And there's a LIFO conformity rule that says if you use it for taxes, you have to use it for your financial reports too.
Now let's switch gears and look at the Indian context. LIFO is a big no-no under Ind AS, which is basically converged with IFRS. So a company like Reliance Retail will use either FIFO or the weighted average method. What does this mean? Well, their inventory value on the balance sheet is much closer to its current replacement cost. But during inflation, their cost of sales might look a little low, which could inflate their gross profit.
Okay, so now we know how inventory is valued and how costs are assigned. Let's move on to our diagnostic tools. These are the ratios that tell us how efficiently a company is actually managing this super important asset.
First up, we've got inventory turnover. In simple terms, it just measures how quickly a company is selling its stuff. Generally, a higher number is better. It suggests they're efficient, but like with all ratios, context is absolutely everything.
See, this is where you have to put on your detective hat as an analyst. A super high turnover could mean fantastic management, or it could be a red flag that the company is always running out of stock and missing out on sales. If you see high turnover, but their sales growth is slowing down compared to their rivals, you need to investigate.
Next, we have days of inventory on hand, or DOH. This is just the flip side of the turnover ratio. It tells us the same story, but in terms of days. And here, a lower number is usually better, because it means cash isn't tied up in inventory for too long.
So, if you're looking at a company and you see its DOH creeping up year after year, or it's way higher than its competitors, alarm bells should be ringing. It could mean they have warehouses full of products that nobody wants, which will eventually have to be written down, and that's going to hit future profits hard.
All right, for our final step, let's see how this all comes together. We're heading into the footnotes of the financial statements. This is where companies have to tell you the details, and it's where we, as analysts, find the real story.
Check this out, a real-world example from the Volvo Group's annual report. In this one short sentence from their inventory note, they've confirmed two absolutely critical pieces of information for us: their valuation principle and their cost formula.
And from that one note, we can find out almost everything we need. We'll see the cost method they use, the total value broken down by category, and, most critically, the amount of any write-downs for obsolescence. This gives us powerful clues about how effective management is and what future risks might be lurking.
Let me say this one more time because it's a classic exam trap. If you see a question about inventory value recovering after a write-down, the very first thing you do is check IFRS or US GAAP. That single detail will give you the correct answer. Okay, let's test that out with a quick CFA-style question. A company using US GAAP writes its inventory down. The next year, the value bounces back. What's the new balance sheet value? Go ahead and pause here, think it through, and pick your answer.
If you picked A, $800,000, you are spot on. And why? Because the company uses US GAAP, and US GAAP says absolutely no reversals of write-downs. The moment they wrote it down to $800,000, that became its new cost basis, period.
All right, so that wraps up Module 10. We've officially built your analyst's toolkit for inventory, from core valuation principles and the impact of cost methods, all the way to the diagnostic ratios and critical disclosures that give us those deep insights. Next up, we'll dive into Module 11 and apply our analytical skills to long-term assets. I'll see you there.
All right, welcome. Today, we're going to break down one of the most critical parts of the balance sheet, long-term assets. We're actually going to follow an asset's entire journey, from the moment a company acquires something like a patent all the way to when it finally sells off that old machinery. Let's dive right in. So, this is Module 11 of our CFA Level 1 2025 Financial Statement Analysis course. And our entire focus today is on getting you comfortable with analyzing a company's long-term assets. We're going to follow the complete life cycle of an asset, which is a really intuitive way to understand this. First up, acquisition. That's how a company gets a new asset on its books. Then we'll talk about impairment, which is what happens when its value drops unexpectedly. Next, derecognition, when it's sold or retired. And finally, the most important part, analysis, where we figure out what it all means for us as analysts. Okay, first up, acquisition. Let's dig into how a company actually gets an asset onto its balance sheet, and we'll start with those tricky intangibles. So, intangible assets really come onto the balance sheet in three main ways. A company can just go out and buy one, like a patent. It can develop one itself through research and development. Or, and this is a big one, it can get one as part of buying another entire company. And, you guessed it, each method gets treated differently in the accounting world. Okay, pay close attention here because this is probably one of the most frequently tested differences between IFRS and US GAAP. Under IFRS, you expense the research costs, but the development costs, well, those can actually become an asset. They can be capitalized if a bunch of criteria are met. US GAAP, on the other hand, is much stricter. It generally makes you expense both research and development. The big exception is for some specific software development costs. And that brings us to a really interesting one, Goodwill. Now, Goodwill is a unique intangible asset because it only shows up when one company buys another. It's basically the premium you pay over the fair value of all the assets you can actually point to and identify. So think of it as paying for things like the target company's great reputation, expected synergies, or its super talented team. And here is a massive, real-world example of that. When AB InBev got SAB Miller, they recorded a staggering $74 billion in goodwill. I mean, that's just a huge number. So why so much? Well, as their own report says, they were paying for the assembled workforce and synergies, incredibly valuable things that just don't have a price tag on their own. So we have our assets on the books. Great. But what happens when their value suddenly plummets? That brings us to our second stage, impairment. The rule here is actually pretty simple. You have to record an impairment loss when an asset's book value, its carrying amount, is more than what you can hope to recover from it.
and that recoverable amount is just what you could get from either using it or selling it.
And yep, you guessed it, we've got another key difference between IFRS and US GAAP. IFRS uses a simple one-step test. Is the carrying amount greater than the recoverable amount? Boom, that's it. US GAAP, however, has a two-step process. First, you do a recoverability test using undiscounted cash flows. And only if it fails that test do you move on to step 2 and actually measure the loss.
Let's walk through an IFRS example together. So we have a carrying amount of 18,000 pounds. We need to find the recoverable amount. Remember, it's the higher of its fair value less cost to sell, which is 8,000 pounds, and its value in use, which is 14,000 pounds. So 14,000 pounds is our recoverable amount. The loss is simply the book value minus that recoverable amount, which gives us a 4,000 pound impairment. Now let's do the same thing for US GAAP. Step 1. Is the $18,000 carrying amount greater than the $16,000 in undiscounted cash flows? Yes, it is. So we know it's impaired. Now we go to step 2. We measure the loss. That's the carrying amount minus the asset's fair value. So $18,000 minus $10,000 gives us an $8,000 loss. See? A very different result.
And this brings us to an absolutely critical exam point. Seriously, highlight this one. Under US GAAP, once an asset is impaired, that loss is permanent. It can never be reversed, even if the asset's value bounces right back. IFRS, on the other hand, does allow for reversals. This is a key distinction you have to remember.
So, what happens when an asset's useful life with the company is finally over? Well, that's derecognition, the process of taking it off the balance sheet, which usually happens when it's sold.
The calculation here is really straightforward. The gain or loss is simply what you sold it for, the sale proceeds, minus its book value at the time you sold it. And don't forget that carrying amount is just its original cost minus all the depreciation you've booked over the years.
Let's make this real. Say a company sells its old pizza ovens. They get $3.1 million in cash. The ovens had a book value, or carrying amount, of $1.9 million on the books. Well, the difference is a $1.2 million gain on the sale, and that hits the income statement. Oh, and the full $3.1 million in proceeds? That shows up as a cash inflow from investing activities.
Okay, so we've covered the life cycle from an accounting point of view. Now for the fun part. Let's put on our analyst hats. How do we actually use all this information to evaluate a company?
As analysts, we have a whole toolkit of ratios to diagnose a company's health. The fixed asset turnover ratio shows us how much revenue bang they get for their asset buck. Then you have average age and remaining life, which are kind of like a health checkup for the assets. You know, are their factories getting old and creaky in need of a costly upgrade soon?
So in the US context, think about Tesla building a new gigafactory. They spend billions, so their fixed assets on the balance sheet just skyrocket. In those early years, their fixed asset turnover ratio would naturally look pretty low because the revenue from that factory hasn't fully ramped up yet. Now, let's jump over to the Indian context. Imagine Infosys acquires a smaller tech firm. As an analyst, you'd look really closely at the goodwill they recorded. A very high goodwill number might be a red flag that Infosys paid a huge premium, and they're betting heavily on future synergies to make it worthwhile.
All right, let's pull it all together and do a quick recap of the most important points you need to lock in, especially for the exam. First, always remember the R&D capitalization differences. It's a classic. Second, know the one-step IFRS versus the two-step US GAAP impairment tests, and that crucial no reversal rule under GAAP. Third, the gain or loss on sale calculation is simple, just proceeds minus carrying value. And finally, use those key ratios to really understand asset efficiency and age.
Okay, let's test this with a practice question. We have a UK company, so they're reporting under IFRS. You're given the carrying amount, fair value, cost to sell, and value in use. Your job is to find the impairment loss. Take a second and think it through.
All right, let's break it down. The correct answer is B. Since this is IFRS, the first thing we need is the recoverable amount. That's the higher of two numbers, fair value less cost to sell, which is 16.8 million pounds, minus 800K, so 16 million, or the value in use, which is 14.5 million pounds. The higher of those two is 16 million pounds. Now it's easy. We just take the carrying amount of 19.1 million pounds, subtract that $16 million recoverable amount, and that gives us our impairment loss of 3.1 million pounds.
And that is a wrap on our deep dive into the analysis of long-term assets in Module 11. You now have a really solid framework for understanding the entire asset life cycle. Next up, we're going to cross over to the other side of the balance sheet in Module 12, where we'll explore some pretty complex topics in long-term liabilities and equity, including leases and pensions. I'll see you there.
Welcome to CFA Level 1 2025 Financial Statement Analysis. We've made it to Module 12, the final module of our course. We're going to wrap things up by tackling some really important and kind of tricky topics in long-term liabilities and equity. Let's get into it. So here's what's on deck for our grand finale. First, we're going to decode the world of leased accounting. Then, we'll get into the long-term promises of pension plans and the sneaky details of stock compensation. And finally, we'll pull it all together with the key things you, as an analyst, absolutely need to know.
All right, first up, leases. You know, companies lease everything these days. Think about a U.S. tech giant like Meta leasing huge office buildings, or an Indian airline like Indigo leasing its entire fleet of aircraft. How they account for these deals can totally change the way we see their debt, their profits, and their cash flow. It's a huge deal.
Now, on the surface, a lease is super simple, right? You pay money to use something you don't own. Easy. But for us, as analysts, that's where the simplicity ends. The real story, the important stuff, is buried in the details of that contract. That's what tells us if it's just a simple rental or something much, much bigger.
Okay, now this is where it gets really interesting. Look at these 5 criteria. The crazy part is, under both IFRS and US GAAP, if a lease meets just one of these 5 conditions, just one, it stops being treated like a simple rental. Instead, bam, it gets put on the balance sheet just like the company bought it with a loan.
So this brings up the big question, right? You might be thinking, okay, that's a neat accounting trick, but does this classification really matter to me as an analyst? The answer is 1,000% yes. And the next slide is going to show you exactly why this one little decision can completely change how you view a company.
And here's the proof in the pudding. Just look at the impact under US GAAP. In that first year, an operating lease makes your profit look better because the expense is lower. But, and this is a big but, it makes your cash flow from operations look way worse. This choice can completely warp key ratios you rely on every day.
And of course, there's a classic IFRS versus US GAAP twist you got to watch out for. IFRS decided to simplify things. For the company leasing the asset, pretty much all leases are treated the same, like finance leases. But US GAAP, nope, they keep those 2 different models, which means comparing an IFRS company to a US GAAP company gets really tricky.
All right, let's shift gears from leases and tackle another monster liability, pensions. We're talking about long-term promises made to employees, promises that can create some of the absolute biggest and most volatile liabilities you'll ever find on a balance sheet.
Now, it is vital that you know the difference between these 2 plans. A defined contribution plan, think of a 401k in the US or contributions to India's national pension system, is simple for the company. They put the money in, and their job is done. The employee takes all the risk. But a defined benefit plan? Oh, that's a different story. The company promises a specific payout no matter what. They bear all the risk. And that, my friends, is where these massive liabilities come from.
And if you want to see just how massive we're talking, check this out. This is from the UK's BT Group. Their net pension liability was over £6.3 billion. And this isn't some one-off thing.
Huge public sector companies in India, like the State Bank of India, are dealing with enormous pension funds that you have to analyze very, very carefully.
So how does a number this big change every year? Well, under IFRS, the changes flow through the financial statements in three places. You've got service costs and net interest, which go right to the income statement. But then there's this third piece, remeasurements. This is where things like surprise investment gains or losses go. And guess what? They bypass the income statement completely and go straight into other comprehensive income, or OCI. That's a critical place to look for hidden volatility.
Okay, on to our third and final major topic, stock-based compensation. Now, this one's tricky because it doesn't use cash right away. But make no mistake, it is a very, very real expense that hits a company's earnings and waters down the value for existing shareholders. You'll read statements like this from companies like Apple all the time. They'll say the goal is to get management and shareholders on the same team. And look, that makes sense. But our job as analysts is to look past the corporate speak and ask the tough question. What's the real economic cost of getting everyone aligned?
So stock comp really comes in two main flavors. You've got stock grants, which are pretty simple to value, but then you have stock options, and these are much, much trickier because you have to estimate their value. They're a favorite tool for high-growth tech firms everywhere, from Silicon Valley to Indian IT giants like Infosys.
And when I say options are tricky to value, this is why. You've got to plug all these assumptions into a model, and while some of them are easy to find, others are pure estimates. Just look at volatility and expected life. Management can tweak those assumptions, and even a small change can have a huge impact on the expense that gets reported.
Whew! Okay, so we've gone through leases, pensions, and stock comp. A lot of heavy stuff. The big question is, what do you actually do with all this information? This is where we talk about moving beyond the numbers on the page and digging into the notes to find the real story.
You know, it really all boils down to one simple golden rule. You have to read the footnotes. Always. Think of this checklist as your treasure map. It tells you exactly what to hunt for, whether you're adjusting for leases, checking up on a pension's health, or questioning the fuzzy math behind executive pay.
Okay, lean in, because this is a massive tip, both for the exam and for your actual job. Deep in the footnotes, companies have to tell you about something called unrecognized compensation cost. Seriously, this is like a gift from the accounting gods. It's a little crystal ball that tells you exactly how much expense from past stock awards is guaranteed to hit the income statement in the future. Take Coca-Cola, for example. They're basically telling you, hey, just so you know, we've got $335 million in expenses that are already baked in and will show up over the next couple of years. You can use this nugget of info, whether you're looking at Coke or an Indian tech company like TCS, to build a way more accurate forecast than anyone who's ignoring the footnotes. All right, time to put that knowledge to the test. Have a look at this question. When a company starts a finance lease, what's the right number to put on the balance sheet as a liability? Take a second to think it through.
If you picked A, you nailed it. The rule is that the lease liability is always recorded at the present value of the future lease payments. It's not the fair value of the asset. That's a fundamental point you've got to remember. And let's do one more. How does a company show this kind of defined benefit pension plan on its balance sheet? Do they list out the asset and the liability separately, or do they do something else?
And the correct answer is B. Both IFRS and US GAAP require companies to show the net number. In this case, since the obligation is bigger than the assets, the plan is underfunded, and the company reports a net pension liability of 1 million euros.
You know, the big theme running through all of this is that a company's biggest promises, whether it's to their landlords, their employees, or their top executives, they're not always obvious on the face of the balance sheet. Your job as an analyst is to be a detective. You've got to dig into those footnotes to uncover the real truth. The question you should always be asking yourself is this: what future obligations are hiding in plain sight. Congratulations on making it through the entire financial statement analysis course. You did it!
All right, welcome back to our CFA Level 1 2025 Financial Statement Analysis course. We're jumping into Module 9 now, and let me tell you, this is a big one. We're tackling the analysis of income taxes, a topic that honestly trips up a ton of people. But getting this right is what separates a good analyst from a great one. So let's decode this thing. Here's how we're going to break it down. First, we'll tackle the main puzzle, why accounting and tax numbers are different. Then we'll look at permanent versus temporary differences, which leads us straight into deferred taxes, DTAs and DTLs. After that, we'll cover the key tax rates you need to know. And finally, I'll give you a simple analyst checklist to put it all into practice. Let's do it. Okay. So let's start with the big question, the central puzzle you have to solve as an analyst. You look at an income statement, you see a line for tax expense, and you think, okay, that's what they paid the government, right? Well, wrong. Almost never. That number is rarely the actual cash that left the company's bank account. And your job, what we're here to learn, is to figure out why and what that difference is really telling you about the company. And the whole mystery starts right here. You see, every company basically keeps two sets of books. And no, it's not sketchy, it's completely legal. In fact, it's required. Think of it like this. One book is for you, the investor. It follows accounting rules like GAAP or IFRS, and its whole purpose is to give you a fair picture of the company's performance. The other book, that's for the tax authorities. It follows the tax code, and its one and only job is to figure out how much tax the company owes. So you've got two different audiences, two different rule books, and that means two different bottom lines. That's the source of the gap. Okay, so let's look at the first reason for the gap. These are called permanent differences, and they're actually the easy ones to understand. Just like the name says, these are differences between the accounting rules and the tax rules that will never reverse. Never, ever. It's a permanent wedge driven between those two sets of books we just talked about. So what does this look like in the real world? Imagine a company gets hit with a huge fine for, say, an environmental violation. For their accounting books, that's a legitimate expense, right? It reduces their profit. But when they go to the tax man, the government basically says, whoa, hold on. We are not giving you a tax deduction for breaking the law. So that expense is not tax deductible. Boom, a permanent difference. Same idea with things like interest income from tax-exempt municipal bonds. It's income for the books, but not for tax. It creates that permanent gap. Okay, now for the fun part. This is where most of the action is. We're talking about temporary differences. And if you remember one word for this, make it timing. It's all about timing. It means something gets counted in one year for accounting, but in a different year for tax. The key is eventually, over the long run, it all washes out. But in any single year, you've got a mismatch. And the absolute classic example, the one you'll see a million times, is depreciation. So for you, the investor, the company wants to show nice, smooth, predictable earnings. So they use the straight-line depreciation method, slow and steady. But for the tax authorities, oh no, they want the biggest tax break they can get right now. So they use an accelerated method to get huge deductions up front. The total amount of depreciation over the asset's life is exactly the same, but the timing is worlds apart, and that creates a massive temporary difference. So we have these timing differences. So what? What do we do with them? We can't just pretend they don't exist. Well, this is where accountants came up with a pretty clever solution. They create two special accounts on the balance sheet to keep track of it all: deferred tax assets, or DTAs, and deferred tax liabilities, or DTLs. These are literally the solution to the whole timing puzzle. Okay, now pay close attention to this one. Seriously, screenshot this, write it down. This is your exam day lifesaver. It looks a little complex, but the logic is actually super simple once you get it. Let's just focus on assets for a second. If an asset's value on the accounting books, the carrying amount, is more than its value for tax purposes, the tax base, what does that mean? It means you've already taken more depreciation for tax than for accounting. You got your tax break early, so you're going to have to pay more tax later. That creates a future liability, a deferred tax liability. See? And if it's the other way around, where the accounting value is less than the tax value, it means you've paid too much tax now and you'll get a break later. That's a future benefit, a deferred tax asset. The logic is just flipped for liabilities. Master this table and you'll be golden. All right, let's put this into the real world. Think about a US company like Tesla. They're building a massive new gigafactory. For tax purposes, you bet they're using the most aggressive, accelerated depreciation schedule they can. Why? Because it slashes their taxable income today and saves them a boatload of cash. But they know that down the road, their depreciation deductions will be smaller and their tax bills will be bigger. That future IOU to the tax man, that's a deferred tax liability, a DTL, sitting right there on their balance sheet. And it's the exact same story in India. A company like Mahindra & Mahindra building a new auto plant will use similar tax incentives to get those upfront deductions, creating a DTL in the process. Now, let's flip it around and look at a deferred tax asset. A perfect example is Apple in the US. Imagine they sell 1 million new iPhones. For their financial reports, based on the matching principle, they have to estimate and expense the future warranty costs right now. That reduces their accounting profit. But the IRS says, nope, you can only deduct that expense when you actually spend the cash to fix a phone. The result? Apple ends up paying more cash tax today than their accounting profit would suggest. They've essentially prepaid their taxes. And that prepayment, that future tax benefit, is a deferred tax asset. You see the same thing in India with a company like Bajaj Auto. They sell a ton of motorcycles, they book an expense for future warranty claims, but they can't take the tax deduction until they actually pay for a repair, creating a DTA. Okay, analyst hat on. This is a big one, especially under US GAAP. It's called the valuation allowance. Think about it. A deferred tax asset is basically a coupon for future tax savings. But that coupon is worthless if you don't have any future profits to save taxes on, right? So if a company thinks it's more likely than not that they won't be profitable enough to use that DTA, they have to set up this account, a valuation allowance, which is basically a pile of sandbags that reduces the value of the DTA. So when you see a big valuation allowance, or one that's growing, that is a massive red flag. It's management telling you, yeah, we're not so sure we're going to be making enough money in the future. All right, so we've got the mechanics down. We know where these DTAs and DTLs come from. Now let's switch gears and look at the scorecard. How we as analysts actually measure what's going on with a company's taxes using 3 really important rates. First up is the statutory rate. This is the official headline number. You know, in the US, it's currently 21%. It's the rate written into the law. But here's the secret. Almost no big company actually pays that rate. The rate they do pay, based on their income statement, is called the effective tax rate. You calculate this by taking their income tax expense and dividing it by their pre-tax income. And why is it different from the statutory rate? Because of all those permanent differences in global operations that we've been talking about. But then there's the third rate. And for anyone doing valuation or building a DCF model, this one is king. It's the cash tax rate. And it's beautifully simple. You just ask, how much actual cash went out the door to the government? You take that number, divide it by pre-tax income, and that's it. This rate cuts through all the accounting noise and tells you the real true blue cash impact of taxes on the company. And check out this real-world example from Johnson & Johnson to see just how dramatic the difference can be. The U.S. statutory rate was 21%, but look at their effective tax rate, just 8.3%. That's a massive gap. So what's going on? Well, you dig into their footnotes and you find out it's mostly because they make a ton of money in countries with way lower tax rates. This is the perfect illustration of why you can never just grab the statutory rate and plug it into your model. You have to dig deeper. So let's put it all together into a practical checklist. The next time you open an annual report and flip to that scary-looking tax footnote, here's what you do. Number 1, look at the deferred tax liabilities. Ask yourself, are these going to reverse and require a cash payment soon, like from depreciation? If yes, you should probably treat that DTL like debt in your valuation. But if it's not expected to reverse for a really long time, maybe it's more like equity. Number 2, hunt for that valuation allowance. Is it there? Is it getting bigger? That's your signal to worry about future profitability. And number 3, find the tax rate reconciliation. This is where the company explains the gap between the statutory and effective rates. You need to figure out what's causing that gap, and most importantly, is it sustainable? All right, let's do a super quick recap. The big puzzle? Tax expense on the income statement is not the same as cash tax paid. Why? The clues are the permanent and temporary differences between accounting and tax rules. The result of all this? Temporary differences create our DTAs and DTLs. And how do we score it? We use those 3 key rates: statutory, effective, and most importantly, the cash tax rate. Okay, time to test your knowledge. Quick question for you. A company recognizes an expense for accounting, but that expense is never allowed for tax purposes. What does that create? Is it A, a deferred tax liability, B, a temporary difference, or C, a permanent difference? And the answer is C, a permanent difference. The magic word there was never. If a difference will never reverse, it's permanent. Simple as that. Okay, one more. The company uses straight-line depreciation for financial reporting and an accelerated method for taxes. What does this situation most likely result in? A, a deferred tax asset, B, a temporary difference, or C, a permanent difference? And the correct answer here is B, a temporary difference. Why? Because over the life of the asset, the total depreciation is exactly the same. The only thing that's different is the timing. And just to take it one step further, we know that this specific kind of temporary difference results in a deferred tax liability. Fantastic job getting through that. That's our deep dive into the analysis of income taxes. And please remember this, the tax footnote is so much more than a boring compliance document. It's a goldmine of information. It's a window into the quality of a company's earnings and what management really thinks about its future profits. So always be asking, what are these numbers telling me about tomorrow's cash flows? That officially wraps up Module 9. Next up, we're going to get into the nitty-gritty of Module 10, where we'll tackle the analysis of inventories. I'll see you in the next one. All right, welcome to Module 10 of our CFA Level 1 Financial Statement Analysis course. Today, we're tackling financial reporting quality. And to really get this, we've got to think less like an analyst and a whole lot more like a detective. Yep, you heard me right. We're putting on our detective hats. Because a great analyst, a truly great one, doesn't just read the financial statements. No, they investigate them. They're sifting through the clues, digging deep to uncover the real story hiding behind all those numbers. Our mission is to find the truth. And let me tell you, this is a seriously important skill. We've seen massive scandals that have just shattered investor confidence. From huge names like Enron and WorldCom in the US, all the way to the Satyam scandal over in India. These cases are powerful reminders that what you see isn't always what you get. And failing to spot those red flags, well, that can be a very, very costly mistake. So, where do we even begin our investigation? Well, it starts with the very first clue every financial detective has to understand: the critical difference between the quality of a financial report and the quality of the earnings inside that report. They sound similar, but trust me, they are not the same thing. Okay, this slide breaks it down perfectly. On one side, we've got reporting quality. Think of this as the quality of the case file itself. Is the information compliant with the rules? Is it transparent? Is it accurate enough to be useful for making decisions? Then on the other side, you have earnings quality.
This is all about the results. Are the company's profits sustainable? Are they generating a good return? Here's the key takeaway. You can have a high-quality, perfectly honest report that clearly tells you the business is actually doing terribly.
So let's nail this down. High-quality reporting just means we're getting the information we need to make good decisions. It's not just about checking off boxes for compliance. It's about the report giving us a faithful, honest picture of the company's economic reality. And for earnings quality, the magic word is sustainable. High-quality earnings aren't some one-time fluke, right? They're not from selling off a building or getting lucky with currency rates. They come from the company's core business, and you can reasonably expect them to continue into the future and provide a solid return. Okay, so as detectives, we need a way to classify the evidence we find. And that brings us to the financial quality spectrum. Think of this as your main framework for figuring out just how trustworthy a company's financial reports really are. This spectrum is basically our rating system. Up at the top, you've got the gold standard, perfectly compliant reports showing sustainable, high-quality earnings. But as we move down, things get murky. First, you might have a good report that just happens to show low-quality earnings. Then you slip into the gray area of biased choices, then outright earnings management. And finally, you hit the red zone, reports that don't follow the rules, or at the very bottom, are just completely made up. Our job is to figure out where a company sits on the spectrum. Now let's zoom in on that gray area. This is where things get really interesting, because even when a company is technically following all the rules, managers can still make biased accounting choices. This is where we learn to read between the lines. Managers can lean one of two ways, aggressive or conservative. Aggressive choices, like booking revenue a little too soon or pushing expenses in the next quarter, they make the current period look fantastic. But it's often like borrowing from the future. Performance down the road is going to take a hit. Conservative choices do the opposite. They might lower today's performance, maybe by taking a big provision for a future loss, but that can help future periods look even better. We don't want either. What we're looking for is neutrality. So this raises a huge question. Why on earth would managers do this? To get that, we need to dive into the psychology of it all. And the best framework for that is the fraud triangle. It helps us profile the motive, the opportunity, and the rationalization behind these bad decisions. The key here is that it's usually not just one thing. It's a perfect storm of all three elements. First, there's motivation or pressure. Maybe the CEO gets a huge bonus if they hit a certain earnings number. Second, there's an opportunity. Maybe the internal controls are weak or the board of directors just isn't paying attention. And finally, there's the rationalization. This is the story they tell themselves. The CFO of Enron, for example, famously said he got approvals from lawyers and accountants, which helped him justify doing things he knew were wrong. Okay, enough theory. Let's get practical. As a detective on the case, what actual clues are we looking for? It's time to build our checklist of forensic red flags that can signal big trouble. A huge red flag, especially these days, is the use of misleading non-GAAP metrics. This is all about presentation. A company will create its own adjusted earnings numbers to try and paint a much prettier picture than the official GAAP numbers show. The Groupon case from back in 2011 is a perfect example from the US. Just look at this. According to the official rules, GAAP, they had an operating loss of over $117 million. But they presented this non-GAAP metric they invented called adjusted CSOI. So how did they magically get to a positive $81 million? Simple. They just added back all their online marketing expenses, claiming they were a one-time cost. The SEC, unsurprisingly, did not agree. And look at the difference. We're talking about a swing of nearly $200 million. That one adjustment turned a massive loss into a pretty nice-looking profit. This is exactly the kind of thing that should make your detective senses tingle. So here it is, your detective's checklist. Every single one of these questions is a potential red flag. Take cash flow, for instance. Is the company reporting big profits, but that profit never seems to turn into actual cash? That is a huge warning sign. Or how about revenue? Are their receivables growing way faster than their sales? That could mean they're booking sales they're never going to collect on. These are the core questions you have to be asking. Okay, you've got the checklist. Let's put it to the test with a quick practice question. Read this over and think. If a company is booking revenue too early, what's going to happen with its ability to collect cash compared to its rivals? And the correct answer is C. If days sales outstanding, or DSO, is going up, it means it's taking the company longer and longer to get the cash from the sales it's already put on the books. This is a classic textbook sign that a company might be recording revenue for sales that aren't quite real yet. So let's do a quick recap. Your financial detective's toolkit is now loaded up. You know how to distinguish between the quality of the report and the quality of the results. You can use the quality spectrum to classify what you find. You get the why behind misreporting with the fraud triangle, and you've got a killer checklist of red flags to guide your investigation. And that's a wrap on Module 10. You are now ready to look at any financial statement with a healthy dose of professional skepticism. But let me leave you with one final thought. In a world where there's so much pressure to hit those quarterly numbers, is any report ever truly neutral? Or is our job as detectives just to figure out which way it's biased? Next up, in Module 11, we'll apply this same skeptical mindset to the analysis of long-term assets. I'll see you there.
Welcome back to our CFA Level I 2025 course on financial statement analysis. We are diving into Module 5, where we're going to get into a really crucial skill, looking at an income statement and seeing the story behind the numbers. We're going to move way past the headlines and learn the core techniques, like common size analysis and financial ratios, that let you truly understand how a company is performing. So, where do we even begin? Well, we start with a simple but powerful truth. On their own, raw numbers can be incredibly misleading. You see, great financial analysis isn't about judging one number in isolation. It's all about finding context, making comparisons, and uncovering the narrative that the data is trying to tell us.
Let me just throw a question out there for you. A company reports a $10 million profit. Is that good? Now, your first instinct might be to say, yeah, of course. But the real analyst's answer, you guessed it, is it depends. A number without any context is just noise. To turn that noise into a useful signal, we need to compare it to something.
And here is that context in action. Look at this. Both companies made the exact same $10 million profit. But when you dig one layer deeper, the story completely changes. Company A made that profit on just $50 million in sales. That's a fantastic 20% margin. Meanwhile, Company B needed 10 times the revenue, a whopping $500 million, to generate the same profit. That's a tiny 2% margin. All of a sudden, it's a no-brainer who the better performer is. And this is precisely why we need to standardize numbers to make a fair comparison.
So how do we do that? How do we standardize? Well, our first tool in the toolkit is something called vertical common size analysis. The idea is actually really simple but incredibly powerful. You take every single line on the income statement and you express it as a percentage of total revenue. Revenue becomes your 100% baseline. This immediately strips away the effect of size, letting us compare a corporate giant to a tiny startup, or track one company's journey over 5 years, all on a true apples-to-apples basis. All right, so common size analysis gives us that bird's eye view. Now, let's grab our magnifying glass and zoom in with our next set of tools, profitability margins. I want you to think of these as checkpoints as we travel down the income statement. Each one tells us a different part of the story about how well the company turns its sales dollars into actual profit. Our very first checkpoint is the gross profit margin. This tells us what's left over from each dollar of revenue right after paying for the direct costs of making the product or service, what we call the cost of goods sold, or COGS. A high margin here suggests the company has strong pricing power, or it's just really efficient at production.
Moving a little further down the line, we get to the operating profit margin. This takes things a step further. We subtract not just COGS, but also the core costs of actually running the business. You know, things like research and development, marketing, and general admin expenses. This margin is absolutely critical because it shows us how profitable the company's main business is, totally separate from how it's financed or what its tax situation looks like.
And then, all the way at the bottom, we find the net profit margin. This is it. This is what's left for the owners after every single expense. Interest on debt, taxes, you name it, has been paid. It's the ultimate bottom line measure of profitability. You could have a company with an incredible operating margin, a real rock star at its core business, but if it's drowning in debt, you'll see all that hard work just get washed away right here in a much lower net margin.
And this is so important to remember. Margins are dictated by the business model. Let's take a capital-intensive manufacturer like Tesla in the US. They have these enormous costs tied up in giant factories, raw materials, and massive R&D budgets, which naturally puts a lot of pressure on their operating margins. Now compare that to an asset-light IT services firm like Infosys in India. Their biggest cost isn't machinery, it's the salaries of their brilliant engineers. Their main asset walks out the door every evening. With lower capital needs, their operating margins can be structurally much higher. This is exactly why you can't just compare a car company to a software company directly. Context is king.
Okay, so we've got all these different pieces of the puzzle. Profitability, efficiency, debt. How do they all connect and influence each other? Well, that's where the master tool of analysis comes in, the DuPont framework. It's brilliant. It starts with the one metric that shareholders care about most, return on equity, or ROE, and it systematically breaks it down into its core drivers so we can see exactly what's creating or destroying value for the owners.
So what exactly is return on equity? It's simply the company's net income divided by the average amount of equity its shareholders have invested. It answers the most fundamental question for any owner. For every single dollar I've put into this business, how much profit is it generating for me this year? A higher ROE is obviously better, but the number by itself doesn't tell us how the company is achieving that return.
Okay, here's where the magic happens. We start with that basic ROA formula. Then, using a bit of simple algebra, we expand it out. This lets us regroup the formula into three distinct, powerful drivers. The first piece is our net profit margin, which measures profitability. The second is asset turnover, which measures how efficiently the company uses its assets to generate sales. And the third is financial leverage, which tells us how much debt is used to finance those assets. What this reveals is that a company's ROE is a direct product of these three levers: how profitable it is, how efficient it is, and how much debt it uses.
Let's make this real with a quick example from our source material. We've got two companies, Anson and Clarence. At first glance, Clarence's ROE of almost 9.3% looks way better than Anson's 5.9%. But why? That's the million-dollar question. The DuPont breakdown tells the story. Anson is actually more efficient. It has a higher asset turnover. But Clarence wins on two other fronts. It's more profitable with a higher net margin and, crucially, it uses significantly more financial leverage. It's that combination of higher profitability and higher leverage that's juicing its ROE, even though it's less efficient with its assets.
And this right here is the whole point. As an analyst, your job isn't to be a human calculator. That's the easy part. The real skill, and what the CFA exam is really testing, is your ability to interpret these ratios, to look at the numbers and see the business strategy and the economic story they're telling you.
I absolutely love this quote from the curriculum because it just perfectly captures the essence of what we do. Anyone can plug numbers into a formula.
A true analyst uses the results of that formula as a starting point to ask deeper questions. Why is the margin going down? Why is our turnover getting better? The why is always more important than the what. Now, before you run off and start using these ratios for everything, we need to talk about the fine print, the limitations. You have to be aware of them. If a company is a massive conglomerate with tons of different business lines, its overall ratios can be a meaningless mush. Different accounting choices, like how they value inventory, can make two nearly identical companies look completely different on paper. So please remember, a ratio is a question, not an answer, and never, ever rely on just one ratio to make a decision.
Okay, that was a ton of information, but we've just added some seriously powerful tools to your analyst toolkit. Let's do a super quick recap to make sure it all sticks, and then we'll put your new skills to the test with a CFA-style practice question.
So let's nail this down. We use common size statements to get that apples-to-apples comparison. We analyze our three key profitability margins, gross, operating, and net, to get that layered view of performance. We use the DuPont framework as our master tool to deconstruct ROE into profitability, efficiency, and leverage. And most importantly, our job is to investigate the why, not just calculate the what.
All right, time to test those skills. An analyst has this data for a company. Between year 13 and year 15, its ROE went up, but its ROA went down, while its asset turnover went up slightly. Based only on that info, what can we say about its net profit margin and its financial leverage? Take a second, look at the relationships we just talked about. What's the story here?
The correct answer is C. Let's walk through the logic, step by step. First, let's focus on return on assets, or ROA. We know that ROA is just net profit margin times asset turnover. Now, the problem tells us that ROA went down even though asset turnover went up. Mathematically, the only way for that to happen is if the net profit margin decreased. Okay, that's piece number one. Now, let's look at ROE. We know ROE is ROA times financial leverage. The problem tells us ROE increased, even though we just figured out that ROA decreased. Again, the only way for that to be true is if financial leverage must have increased by enough to more than offset that drop in ROA.
And that wraps up Module 5. You now have a fantastic foundation for evaluating income statement performance. We really got to grips with it. Next up in Module 6, we're going to flip the page and shift our focus to the balance sheet, where we'll explore complex topics like intangibles, goodwill, and financial instruments. I'll see you there.
Welcome to the final module in our course, CFA Level 1 2025 Financial Statement Analysis. This is it, Module 12, where we bring everything we've learned together. We're going to move from just analyzing the past to actively forecasting a company's future. This is all about learning to build the engine that drives almost every valuation. Let's get right into it. Okay, so here's our game plan. We'll start with the nuts and bolts of building a pro forma model. Then we're going to talk about the human element, those sneaky psychological biases that can trip you up. After that, we'll size up the competition, factor in big picture stuff like inflation, and finally, see how our model spits out the crucial inputs we need for valuation. All right, first things first. What exactly is a financial model? Well, you can think of it as a detailed blueprint or a roadmap for a company's financial future. It's our best tool for systematically projecting out the three core financial statements. You know them: the income statement, the balance sheet, and the cash flow statement. Now, we typically build the income statement from the top down, and it all, and I mean everything, starts with the single most critical assumption you will make: the revenue forecast. Get that right, and everything else flows from it. From that one number, we can then start projecting costs and other items to get to our bottom line, that pro forma net income. So, how do you make a revenue forecast that you can actually defend? Check out this example for Remy Cointreau. Instead of just plucking a growth number out of thin air, we build it from the ground up. We're forecasting, say, 7% volume growth, and then another 4% lift from better pricing and a richer product mix. You add those together, and that's how you get a robust and, more importantly, an explainable organic growth forecast of 11.3%. And here is something that is absolutely crucial to remember. These statements don't exist on their own little islands. They are all intricately linked together. Think of it like plumbing. Net income from the income statement flows right into retained earnings on the balance sheet, and that same net income is the starting point for the cash flow statement. A well-built model, a model that balances, ensures these links are perfect. It's one of the key checks on your work. Okay, time for a reality check. We can build this beautiful, mathematically precise model, but it's all built on human assumptions. And humans, well, we can introduce some serious systematic errors. We've got to be aware of the common behavioral biases that can completely derail our analysis. And this is the question every single analyst has to ask themselves, probably every day. Your model might be perfect down to the last decimal point, but can you really trust the assumptions you fed into it? Or are you just seeing what you want to see? Now, the CFA curriculum flags 5 key mental traps that analysts often fall into. We've got overconfidence, the illusion of control, conservatism, representativeness, and confirmation bias. Let's just dig into a couple of the biggest ones and talk about how to fight them. First up, the big one, overconfidence. We all have a natural tendency to believe our forecasts are way more accurate than they actually are. So what's the fix? You've got to build in some structured humility. Run multiple scenarios. Don't just have one answer. Build a base case, an optimistic upside case, and a pessimistic downside case. This forces you to ask that critical question, where could I be wrong and by how much? Next is a really sneaky one, confirmation bias. Basically, if you think a stock is a great buy, your brain will start acting like a filter, only letting in the good news that confirms your belief. The counter to this, you have to become your own devil's advocate. You have to deliberately seek out the bear case. Go find research from an analyst who absolutely hates the stock and really try to understand why. All right, let's pull the camera back a bit. We've looked at the company, but no company is an island, right? Its ability to actually make money is hugely influenced by the industry it operates in. And for this, we pull out a classic tool from the analyst's toolkit, Porter's 5 Forces. It's an amazing framework for mapping out the power dynamics in any industry. It helps us figure out who has the upper hand. Is it the company, its rivals, its suppliers, its customers, or maybe even new competitors? Now watch this. When we apply the framework to Rémi's cognac business, it all becomes crystal clear why this business is so profitable. Look at the threat levels. Low, 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 low. It's a consolidated market, meaning just a few players control everything, and it's incredibly hard for a newcomer to break in. This structure gives companies like Rémi immense pricing power, which leads directly to those high and stable margins. Now, let's flip the script. Contrast that with the beer industry. For a company like AB InBev, geography is destiny. In Brazil, they completely dominate. Rivalry is low, buyers are fragmented, and look at the result. Incredible 50% margins. But in the UK, it's a knife fight. Fierce competition and a few powerful supermarket chains completely crush their profitability, down to less than 10%. Same company, same product, but a totally different industry structure means vastly different results. Okay, a good model can't just live in a bubble. It has to account for the broader economy. And inflation is a perfect example of a macro force that hits a company's revenues and its costs, but almost never in equal measure. Your job as the analyst is to model that gap. So when a company is forced to raise prices to offset inflation, the million-dollar question is, what happens to volume? As this example shows, there's usually a trade-off, a push and pull. This is the concept of price elasticity. And a huge part of your forecast is judging just how much volume the company will lose for every percentage point they hike prices. And this highlights a crucial strategic choice you have to model. Imagine a supermarket gets hit with 4% cost inflation. What do? Do they pass all of it on to the customer, protecting their profit margin but losing sales volume, like Analyst D is forecasting? Or do they eat the cost increase, sacrificing margin in the hopes of gaining market share, like Analyst A thinks? Your forecast is essentially a bet on which strategy you believe management will choose. All right, this is it, the moment we've been building towards. We've constructed the model, we've stress-tested our assumptions. Now it's time for the payoff, using our forecast to generate the key inputs for valuation. This is why we do all this work, to figure out what a company is actually worth. One of the most important outputs from any model is something called free cash flow to the firm, or FCFF. You can think of this as the total cash generated by the business that's available to all of its capital providers, both debt and equity holders. And we calculate it by pulling numbers directly from our forecast, starting with operating profit and making adjustments for taxes, non-cash charges, and the investments needed to keep growing the business. So, after all of that detailed analysis, our model for Ramey Quintro gives us a tangible number, a projection of 300 million euros in free cash flow for fiscal 2024. This single number becomes the absolute cornerstone for a discounted cash flow, or DCF, valuation. And this quote from the CFA Institute gets to the heart of it. It's so vital to remember. The model itself isn't the valuation. The model is the engine. It's the rigorous process that produces the high-quality, defensible forecasts you need to then go and perform a proper valuation. Okay, you know the drill. Let's put this into practice with a quick exam-style question to make sure it's all sinking in. Okay, here's the setup. A 10% price hike from a new tax, and we're told the price elasticity is 0.8. Go ahead and pause here if you want to work it out yourself. Ready? So, a 10% price increase times an elasticity of 0.8 means your volume is going to fall by 8%. Once you run that lower volume through the company's cost structure, factoring in what's fixed and what's variable, you land on a new operating profit of $608 million. The correct answer is B. And that wraps up Module 12 in our entire course on financial statement analysis. We've gone from the most basic building blocks all the way to constructing a full pro forma model. But please always remember the most important takeaway. The model gives you the numbers. The spreadsheet gives you precision, but it's your critical judgment, your awareness of biases, your deep understanding of the business and its industry that creates true insight. The number is just the start of the conversation. It's never the end. Congratulations on completing the course.